second session of the Entrepreneurial Education Series, Managing Your Equity and Capital Structure and Cap Table, Best Practices and Things to Avoid. I'm Jeremy Garvey, the Pittsburgh office managing partner of Cozen Connor, and I'm on the board of the PVCA. This series was created in conjunction with the Three Rivers Venture Fair, our flagship event that takes place every 12 to 18 months. Over the course of the 2 days, we are hoping to better prepare entrepreneurs to put their best foot forward for these presentations and to supply them with very valuable knowledge about the entrepreneurial process. Before we get started, as always, I would like to thank the symposium sponsors. Special events and programs like these are only possible because of these folks. In addition to the sponsorship of the series, our sponsors have committed to supporting the 2021 virtual Three River Venture Fair. If you are interested in becoming a sponsor, please contact Micah Whitfield, the PVCA's business development, director of business development, and let her know. And I want to send out a special thanks to our panelists today. We have a great group. All of them have prepared a great deal for this, and I know their time is valuable. So moving to today's event, it is my privilege to introduce the panel. All panelist bios are on the last page, are available on the website. First, our moderator, Chad Cowan. He is a member at Cozen O'Connor. Secondly, Craig Ball, the Director of Strategic Investments and Transactions at UPMC Enterprises. And finally, but not least, Jeff Kovacs, who is a partner at Cohen and Company. Lastly, if you have any questions during the event, please use the Zoom Q&A function to ask a question. And I will now turn the program over to Chad.
Thanks, Jeremy. Sorry for the delay there. Thanks, everyone, for joining us today. As Jeremy mentioned, I'm Chad Cowan of Cozen O'Connor. Delighted to be here today with you to participate in this conversation about capitalization structures and cap table management. As Jeremy said, I'm joined today by Craig Ball and Jeff Kovacs. As Jeremy also said, we'll do a little Q&A at the end. We'll leave some time for that. But we'd like to go ahead and get started with the conversation. So I invite Craig and Jeff to go ahead and join me here. And there they are. So we wanted to sort of start with a basic talking point, sort of a fundamental question of, what are we talking about when we talk about a cap table? What does that mean? So I'll sort of throw that over to Jeff to give everyone a little bit of an explanation as to what do we mean by a cap table?
Yeah, thank you, Chad. Good afternoon, everybody. A cap table, for those of you who are not familiar, is it's short for capitalization table. And it's a document. Most frequently in early stage companies, a entity will maintain that in Excel. It's a document that is tracking all of the investors in a company, typically by class of equity instrument. So it might be common stock. They may have already raised some round of preferred stock. Perhaps there are stock options that have been granted at some point. Even warrants. Usually we see warrants issued in conjunction with debt, most notably convertible notes. And well-crafted cap tables will list out every investor by each class. It will list out the number of shares that are owned or units that are owned, depending on your legal structure. It will outline the dollar amounts that were invested and the dates that those transactions that took place. So my perspective is that this is a living, breathing document. It's something that should be created at the earliest formation of a company. It's something that is updated regularly. It's a tool not just for current management of the investors and allocations to investors where appropriate, again, depending on your legal structure, but it's also a basis for modeling. And I think we'll maybe talk about modeling later on in terms of what future equity rounds look like and working toward some level of liquidity or exit event at some point in the future. So it's a critically important document for entrepreneurs and their companies to create early on in the existence of the company.
Thanks, Jeff. That's a really good explanation. So I don't really have anything to add to that. I'll turn to Craig. Craig, I mean, can you talk a little bit about why entrepreneurs should care about the cap table and sort of, given that you're coming from the perspective of an investor, when you're looking at that company to make a potential investment, what sorts of things are you looking for in that initial cap table that the company has put together?
Yeah, absolutely. And first, thanks, Chad, and to the PVCA for having me today. It's a pleasure to be with everyone. You know, from an investor standpoint, you know, we're looking at a number of things. Investor history, you know, who's participated in the previous rounds and in what capacity. You know, we're looking for, you know, perhaps maybe even a strategic that's involved that can add value to the company. And you know, kind of like who's been involved, and if we have any partnerships or networks, etc. You know, it also helps us begin framing what the structure of the term sheet might look like, and which we'll kind of get into that later on in today's program. But it really kind of helps from an investor standpoint how we want to begin structuring some of the key economic terms of the term sheet. A few other things that we're looking for is kind of option pool allocation, making sure that there's the right incentive alignment with key employees, key management, etc., and what the remaining option pool might look like, and kind of comparing that with you know, kind of the hiring plans that the company is looking for, and then, you know, kind of looking for what the option pool refresh might look like and how to begin kind of tailoring some of those discussions as well. And then finally, from a purely qualitative standpoint, just we like to see nicely presented, you know, complete, accurate cap tables, just to make sure that management's actually serious, you know, with their time and that they're serious about taking investor money. Nothing's worse, you know, than seeing a cap table on a spreadsheet that's in, you know, back of the envelope, you know, kind of structure. It's just not, you know, kind of best practice, best form. And so we like to see something that it's clean, right, accurate. You know, the last thing we want to do is spend time during diligence, working through a messy cap table, trying to understand that, perhaps, you know, bringing Chad if we're working with outside counsel, you know, kind of billing their time for that extra work. I mean, Chad might like that. We don't really like that. You know, we want to discuss, you know, more important things about, you know, what our investment will mean to the company rather than a messy diligence practice.
You know, one of the challenges that entrepreneurs have is a lot of them are technologists at heart, and a lot of them don't have a lot of business experience, you know, especially first-time entrepreneurs. And there's just the notion of building infrastructure and governance inside an organization. And a cap table is really the perfect place to start, you know, to think about that from the investor's perspective, because they're looking for infrastructure. They're looking for the beginnings of governance of a real company at some point. And I think if an entrepreneur can help put that in place and help people like Craig and other investors understand that there's the beginnings of governance and infrastructure in place, it becomes meaningful to them.
That's a really good point. And one thing that I will add to that is documentation. I can't stress that enough. Have signed agreements with all recipients of equity. If you don't, as Craig suggested, you'll end up with a financing where there's an entire side project where you're spending tens of thousands of dollars, which again, might be okay with me, but it's going to waste your time. It's going to detract from the financing. If you don't have all of that in place, you effectively have to recreate the history of every grant you've ever made. And I think I mean, Craig can speak to that probably, but it would, it can potentially turn off investors. You end up detracting a lot of your focus from what should be growing the business and going back and trying to remember, okay, we granted so-and-so equity on this date. Particularly the case with equity compensation awards. Often I see folks not involved or counsel at that stage to make sure those awards are properly documented, which sort of takes me into, I think, the next question. I can talk a little bit about this myself, but maybe I'll ask Jeff. Jeff, do you have thoughts on when entrepreneurs should get their counsel or their advisors, particularly accountants or lawyers, and in your case, accountants involved, particularly when we're talking about capitalization structure and putting together the cap table?
Yes, I don't think you can do it too soon. As soon as the entity is organized, to Chad's recent point, we've all seen many instances of a company that is seeking financing or seeking to work with somebody like us through an audit environment, and we're scrambling in the 11th hour to pull documents together. And it adds time, it adds complexity. It could mean extra cost. It could mean that mistakes are made. We prefer to get involved in as early as possible to help play our role, give our perspective on the cap table, the documentation that they're going to need. There's nothing more frustrating than trying to conduct a first-time audit and none of the documents exist, or if they do exist, they're not in an executed form, they're not in a centralized location. There are various iterations of them. We don't know which version of them are correct. So again, back to the governance issue, creating that rigor in the process as early as possible is really important. And then, as I said, it's a fluid document. It's a dynamic document that as changes occur, they really need to be reflected contemporaneous with that change. It's not good to go back in time and create documentation that may or may not be accurate. So you just never know as an entrepreneur when that information is going to be requested of you, and you need to be ready at all times, whether it's investment, audit, potential exit. You don't know if a potential strategic or financial buyer is going to reach out tomorrow and try to acquire your company in some fashion. So you need to be prepared for all of those outcomes.
Sorry, just taking myself off mute. Yeah, I would say, again, I agree with everything Jeff said. It's never too early to do it. Even when the capitalization structure is really basic, perhaps just a group of founders, I would create the cap table that early. And it allows you to sort of build from that and to develop it. And again, documentation is really important. I mean, there's so many easy ways now to, with file management systems to sort of aggregate all of your grant agreements in one place. That it's just, there are tools out there that can help you, and we'll talk about some of the cap table tools later, particularly to help you organize all of your documents so that they're all in one place. And again, you're not scrambling only when you're requested to find these documents. You're ready to answer those questions when they are asked. Investors will take you more seriously. It will alleviate a lot of the stress of raising capital or potentially selling the business.
The other tangible benefit of this is that it really helps start those conversations around what are the goals of the company and the entrepreneur in terms of where do they want to take the company? What do the future rounds of funding look like? What does a potential liquidity event look like? And we've always found, I'm sure the two of you have found, that especially for inexperienced entrepreneurs, it really helps to sort of start with what that end goal looks like, to the extent that they have any amount of visibility or can crystallize that or articulate that and kind of work backwards. And that's a good way to help them sort of understand why the cap table is important and how you sort of move through the cap table as a company grows and becomes larger and scales and takes on more complexity. So sort of always keeping that endpoint in mind, is kind of a best practice for first-time entrepreneurs that haven't worked with a cap table before, so that they understand the importance that at some point when you bring on investors, the expectation is you're going to go through a liquidity event. So knowing what that looks like to the extent that you can visualize that, I think is really important.
Yeah, Jeff, you raise a great point, because that's exactly how, as an investor, we look at it. We go to the end point and work backwards. And so as an entrepreneur, if you are going through that exercise, you're going to be thinking, very, very much of how we as an investor are thinking. And so we're going to be aligned, with better conversations, kind of at the outset, should you go through that best practice like Jeff suggested.
So maybe shifting gears a little bit, and I'll turn to Craig with this question. You mentioned, Craig, a little bit earlier about, so let's say you have a company, you started to develop a product, you're getting attention from potential investors. An investor is going to put what's called a term sheet or a letter of intent in front of you, probably a term sheet in the venture space. What sorts of terms should entrepreneurs and concepts should they be aware of that they're going to see pop up in a term sheet, particularly in the venture setting?
Yeah.
And ones that would affect sort of the capitalization structure of the company, I should say. Yeah,
absolutely. So I will caveat this with, we could spend multiple symposiums on the term sheet. And so rather than boil the ocean of terms, I'll quickly discuss liquidation, preference, participation, and dividends. But a couple things to keep in mind at first. First is, while these are structuring considerations which you should work with your advisors on, Chad and Jeff, these aren't adversarial type terms. You have to keep in mind that investors, unless you're a high net worth, if you're an investor, you have a fiduciary responsibility to your LPs to prudently manage their capital, making good investments on their behalf. And so a lot of these terms are really for that downside risk protection, and they're not meant to be combative, but really, they have the onus on them to make the right prudent investments on behalf of their LPs. The second thing to keep in mind is, and this is oftentimes overlooked, these will affect the economic distributions of a liquidity event. If you have a cap table, and just for simplicity's sake, if you have 30% ownership in a company based upon the share count, these terms, and there's a liquidity event, these terms might take that 30% down to 25% based upon equity distributions. And so that is just something to keep in mind when you're working with your advisors, negotiating with the investor on some of these terms. And last but not least, we're looking for market terms too, as an investor. We're not here to make our money based upon really strong, kind of strong arming you on the structure. That's not what we're here for. We're here to be thoughtful partners, to add value, to grow your business. And so that's why, we are looking to partner with you. This is really just for our own protection. Nothing is worse than if we see, and I'll get into this very shortly, 3x liquidation preference, because that just tells me that the prior investor was more focused on his downside protection than actually helping to build and grow a great business with you. And so it's just really a red flag to see kind of non-market terms. And so again, working with your advisors to kind of meeting in good, fair market terms is really all we're looking for. And so the first one with liquidation preference, you might see something, for instance, like 1x liquidation preference. Let's say that, again, all just for simplistic sake, you have a business that it's going to exit at $50 million. And you have just one round of investors, and you just one primary investor, and he put in $10 million. A 1x preference will be, he gets his first $10 million, and then will share in the participation based upon participation rights, the remaining 40 million, as will the remaining shareholders. You might see something like 2x or 3x, but again, most common kind of current market terms around that 1x. In terms of participation, it's what happens with the remaining $40 million. You might see terms such as full participation, where the investor will then take his pro rata share on an as converted common stock basis and fully participate with remaining common shareholders on the remaining $40 million proceeds. Opposite end of the spectrum would be no participation. And so therefore the investor has the option to either just take his liquidation preference and go on his way, or forego his liquidation preference and just participate on as converted basis from the get-go. And then the capped participation, usually 2 or 3x, which includes your liquidation preference, falls somewhere in the middle. But again, whenever we come to you to discuss these terms in the term sheet, it's very prudent on your end to work with Chad and Jeff to negotiate and kind of work and kind of work with us. And then kind of the final, which really doesn't move the needle, but you're going to see it in a lot of term sheet, and that's dividends. Unlike private equity firms that are investing, they're going to be all in on the dividends. In terms of a venture investment, we will include it. It's going to be about 7 or 8%, and those are going to be kind of rolled into kind of paid in kind common stock distributions. But they're just more a kicker than anything else. They're not going to move the needle one way or another. Again, they're really just for downside protection from the investor standpoint.
And Craig, the dividends that you typically see, are they when and as declared by the board? That's what I usually see, and they're not often ever really activated. So I agree with everything you said. That's it's not something to be
cumulative or non-cumulative too. Cumulative means they're going to be accretive year over year, or non-cumulative, it's just in one defined period. Again, it's feel free to negotiate. It's not going to make or break you as an entrepreneur or an investor one way or another, really, at the end of the day.
Yeah, it really only becomes that important at that liquidity event.
Yeah.
Just to make sure that the company's valuation is carved up appropriately, and those that are entitled to their preferences get those preferences first. And then we know exactly what gets allocated to the rest of the investors based on their rights and privileges.
This question, I guess, can be for either one of you. What are you all seeing in terms of, you talked a little bit about liquidation preference and participation. I would say in my practice, the most common term we're seeing there is 1x non-participating. So you're basically taking the choice to either get your liquidation preference back, or you convert the preferred. By the way, and just as a background, we're talking about, these are terms of preferred stock as opposed to common stock in the charter, just so everyone sort of understands that. I typically see 1x non-participating preferred, but I'm curious as to whether you all are sort of seeing the same thing. Craig gave the example of a 3x a 3x liquidation preference. I would tell you, if I was company counsel and you came to me with that term in the term sheet, I would strongly suggest that you reconsider that term, because that's just an investor, sort of as Craig described, it's really only looking for downside protection, and they're not looking to sort of share in the growth of the company in an equitable way. But I'm curious as to what you all are seeing in terms of market trends on that term.
Yeah, I definitely see that. Probably over the last 10 or 15 years, the liquidation preference has come down. We used to see the 2x, 1.5x, 1.25x. Most term sheets we see these days are 1x. We still see dividends. We're seeing dividends 8%, 10%, although I think that trend is also declining. It's probably 50-50 these days where we see dividends versus no dividends. Also agree on the participation rates, so that I think that's the important point, is that from an entrepreneur perspective, as Craig said, that the ownership percentage that you're giving up doesn't always equate directly to the value that you're giving up, and that you need to understand that and model that in the future. That's a really important point, because you're going to watch a show like Shark Tank and say, you know, I'm giving up 50% of my company for X amount of money. Well, in the real world, it's much more complex than that, especially with some of these preferences. And you need to understand the economics of that and model the economics of that.
Yeah, Jeff, and I agree with that. And you know, Chad, to answer your question, we're seeing a lot of what Jeff just said. 1x non-participation. We do have a handful of investments within our enterprise's portfolio where we do have participation rights, kind of full participation rights. I can't honestly think of one of our investments that goes beyond 1x. And so, and we have dividends, the vast majority of them, but they're right around the 8%. They are cumulative for the majority of our investments. But again, those are pretty standard, and a lot of these things really don't move the needle too much at the end of the day. Even upon a liquidity event, it's not going to make or break either the investor or the entrepreneur when it comes to a successful liquidity event.
Well, I think that's a really good discussion about some of the substantive points in the term sheet. Maybe we can switch gears a little bit and talk a little bit about some logistical concerns. I've seen this might answer some folks' questions that we're receiving in the Q&A. And I'll turn to Jeff on this first. Jeff, could you speak a little bit to sort of what tools are available these days to help folks manage their cap table? I'll quickly say that when I started practicing, I've been practicing for 12 years now, it was typically just a spreadsheet, which I still think is useful in a lot of ways. I think there's some elegance to it. I think it's intuitive. But in the last handful of years, we're starting to see more options. So I'm sure you have some thoughts about what those other options might be.
Absolutely. You're spot on, Chad. You know, for many years, Excel was really the only option that was out there. And it became difficult once a company started to issue a number of other equity instruments outside of common or preferred stock, especially when they started to grant options or you know, any sort of unit awards, depending again on your legal structure. And those spreadsheets become complex. They become difficult to manage. The potential for mistakes to be made is fairly straightforward. And so today, I would say most of our client base uses a tool called Carta. Some others use a tool called ShareWorks. There's a few others in the marketplace. These are wonderful software tools where you will load all of your cap table information into their software tool. And the beauty of it is, especially with option grants and unit grants, and depending on the nature of what you have, it will do all of the accounting requirements that we have to make your job as an owner, a manager, a financial person in the company easier, and mine easier as the accountant. And it will even go beyond. Some of them you can, and we'll get into the subject, I'm sure, in a little while, but you know, those equity instruments typically under accounting rules have to be measured at fair value. And there's the notion of what is fair market value for tax purposes and fair value for financial reporting purposes. They're actually different terms, different terminology. And so from a tax reporting perspective, these tools like Carta can actually compute some of the valuations for you, which that is a whole nother topic, but it just saves so much time, so much trouble at the price point that you will pay for a tool like this to do the administration of your cap table and to potentially do the valuation element of your cap table. It's honestly a no-brainer because otherwise you're going to pay somebody like me or Chad or some other advisor an hourly rate to do work like that, quite frankly is a commodity, and you should be paying commodity prices for a lot of that type of work, unless you get into some very esoteric, more challenging equity instruments or with some features, which does occur periodically. But the beauty of the combination of the administration and the valuation together, as I said, is pretty much a no-brainer.
Yeah, I agree, Jeff. And at risk for sounding like a commercial for Carta, it really is has developed to be a great one-stop shop. All of our portfolio companies use and leverage Carta both for their cap table management, 409A evaluations, et cetera. But really, kind of adding to that, it also is helpful just to have, even at the company level, having one person manage that throughout the life cycle of your fundraising history. And that might be the CFO or the controller, maybe even the CEO, is that if it's early stage enough. But just making sure that the right version control at the company level, having one point person, leveraging Carta or whatever third party platform that you choose to leverage, really just kind of helps with version control, best practice, ease of use. Having that as a point person to work with the attorneys and the accountants and the investors, it just makes for just best practice, seamless work, most efficient, type activities for the company.
One question I actually don't know the answer to. I'm fairly familiar with sort of the inputting process in Carta. One reason why I still like sometimes looking at a spreadsheet is I do find that you can model, financings on a pro forma basis. Maybe you all don't know the answer, and fine if you don't. I mean, is there a modeling feature on Carta? Because I think that's a really important thing for entrepreneurs to understand, is when I raise X, what is the cap table going to look like? How, to what extent will I be diluted? That's an important thing to understand before you go to raise capital. And I haven't personally used Carta for that purpose, but I'm curious as to whether the two of you have.
Yeah, the way I've used Carta, if I've seen it's kind of easy to copy and paste it into a spreadsheet. I'm not looking for, if you have 50 employees receiving stock options, it's quickly to kind of lump each series and shareholder into kind of one category to do your modeling on, right? And so, if we want to get it more complicated, Carta is still good for that. But a lot of the modeling we do gets the historical part of it, we can easily lump together to get a quick picture and then kind of model future scenarios. That's what makes Carta great. It's easy to kind of simplify kind of the messiness that is a cap table, especially if you're raising Series C, Series D. And so it makes for a kind of smooth process to look what future fundraising rounds or exit scenarios might be.
I was going to echo that. That's exactly right. Most entrepreneurs are extracting the information out of Carta, putting it into an Excel spreadsheet. It just gives you better control over your modeling inputs and outputs and how you want to present it. Anytime you have a piece of software that has modeling in it, it's somewhat restrictive in terms of how you can change what the outputs look like. So what I've seen is almost everybody extracts the raw data out of Carta and uses Excel to model from.
One other point I would sort of make about this is, as the entrepreneur, you should take ownership of the cap table. I see a lot of folks sort of push that off to counsel or accountants, but I think it's, dig in and understand what it means and don't sort of outsource that, because I think if you do that, you're setting yourself up to be surprised down the road. I get a lot of clients who sort of just expect that we're going to kind of run with that piece. And I don't think that that's ultimately the best approach to that.
Leverage your advisors, Chad, such as you or Jeff, for the jobs that you can really add value. Right? I can outsource some of this work on the lower value stuff so that I can leverage your expertise for the things that really matter. Right? I don't want to waste your time with cap table management. I want to have a great foundation with my cap table so that, Chad, I can work with you to help, kind of negotiate with an investor or, identify any real material tax implications or reporting implications with you, Jeff, rather than kind of having you manage something that really doesn't matter for you guys to do.
Yeah, I find myself spending a surprising amount of time actually putting cap tables together, and I've encouraged folks to do that. I don't mind doing it. It's a nice break from reading legal documents, but you're right. I mean, that should be something that the company kind of owns and runs with, and our role should be okay, you figure out what the price per share is in this financing. I'm just plugging that number into the financing documents. And, maybe, you can certainly bounce thoughts off of me as we're going through that, but I don't know that it should be necessarily the role of your lawyer to sort of to put it together. And again, happy to do it. I would just say be involved in that process so that you understand what the numbers mean. I mean, I've had clients raise significant amounts of money and not fully understand everything in a cap table, and that often surprises me, because if I were in their shoes, I would want to know sort of every cell, what it means, what the dilution effects are, the dilutive effects are, and how everything fits together. So I would just say, if you're going to involve your accountants or lawyers in that process, make it a team effort. Don't fully outsource it.
Very well said.
Let's shift gears a little bit from, I think that covers sort of the concept of how to manage cap tables and processes for that. Maybe sort of taking a step back to a broader question. I'll ask this of Jeff first. Jeff, since we're talking with entrepreneurs today, what questions, if you have a few, do you get the most often from folks that are just starting a business as it relates to ownership and cap tables, and how do you answer those questions?
Yeah, there's probably a handful of questions, but by far the number one question that we get asked for a company that is just standing up, potentially seeking investment, is, how much is my company worth? And that is as Craig said earlier, that's one of those topics that we could spend hours and hours talking about, because the reality is, in early stage companies, valuation is 99% art and 1% science. There has been lots and lots of guidance provided on how to value early stage companies. There's lots of opinions, there's lots of models. I've read them all, studied them all, lived through them all. There is no right answer. In my opinion, you can pick those models, you can pick that guidance. And the way I try to frame it with entrepreneurs when that question is posed to me is, let's talk about where you're at, what have you done, what have you developed, what stage are you in? Let's talk about where you're going. Let's talk about what you need for development. What are the sources and uses? Let's understand what that is. Let's understand the timeline. Let's map the sources and uses across that timeline so that we know where the fundraising events may be, so that we can also talk about the fact that we need to align that with valuation inflection points all the way until we get to that liquidity event. And again, that's the earlier comment about working backwards once we do that. And I think once you do that, then you create that framework to have that discussion. And then the discussion is around each of those points. So that very first point becomes hard, because most companies don't have a lot to provide at that point. They may not have the right product, the right service, depending on what they are. Really, quite frankly, doesn't matter the nature of the technology. It really matters sort of the stage that they're at, what they have in place, and lots and lots and lots of other factors that need to be discussed and vetted. We can help pull some empirical information from some sources that we all have access to. Again, those are data points. And I think that, in conjunction with other advisors and others that are knowledgeable about the industry and the markets, creates some discussion or expectation around what valuation is. But I think at that point, that is the important thing for an entrepreneur to understand, is that it is a starting point. It becomes a negotiation. Well, Craig will speak to this, but there is no hard or fast number. It's what somebody is willing to give you for what you've done. And then it's the whole discussion over, probably the next issue is, how much do I give up? So maybe I should pause there, let Craig weigh in on the whole valuation end of it from his perspective.
Yeah, Jeff, you touch on a lot of good points, and valuation, as I'm sure many have heard, is more of an art than it is a science. And it depends on the stage of your company. If you are just starting out there's few comps in the marketplace. You might not even have a customer. You might just have a great idea. You might just be a stellar team. An investor at that stage is really investing in your idea and you as a person. And so, they're not looking for, hey, you have X revenue that applied to Y multiple, that's going to give me a post money of this, or a pre money of this. It's oftentimes we just really like you, and we think that there's a good need in the marketplace, and your idea is solving a problem. From there, it's just what do I want to invest in? As future funding rounds happen, I'm going to get naturally diluted, even if I participate in some form or fashion down the road. What's a potential exit going to look like, and what can I reasonably achieve for my initial investment? And so it just becomes this early on discussion, right? And if you are a little bit more mature of an early stage company, and you're raising Series B or Series C and so forth, there you have a lot more touch points on what the value of your company might actually be, because you have maybe a pretty good track record of achieving a healthy annual recurring revenue against a 6 times or 7 times ARR multiple. I can reasonably say that your company is worth $200 million, if you will, and I want this because I know that you're going to maybe raise one more round, and then you're going to have an exit. And so there it becomes a little bit more of a science. And so it certainly moves along that spectrum. I will say with valuation and giving up a percentage of your company is this: don't be afraid to give up a portion of your company. If you own 50% of a $10 million business, great. If you own 10% of a $2 billion business, even better, right? And so, partnering with a good VC that can add value, introduce you to the right partners, have a good presence in the boardroom, really help accelerate your company's growth. Yes, that comes with a cost, and that cost is giving up certain ownership in your company. But if you can grow your overall pie, don't be afraid to give up a certain percentage. It's okay, if you're able to grow that pie, hopefully exponentially over the early stages of your life cycle. So it's sometimes a little daunting, like, whoa, I'm going to give up quite a bit here. But just think about that end goal, that Jeff was rightly speaking to, of what we really think we could be. And if I can own 10% or 15% of a really big pie, all the better.
That's really well said. I wish I had a nickel for every time, we had a young entrepreneur say to us, I don't want to lose control of the company. And then you have to have a very direct conversation around, to your point, Craig, it's spot on. Would you rather have something that 100% of something that's worth 0, right? Because that's where that could head pretty easily. So, and after we have that conversation of how much we give up, it's always a question of, well, I've got some key employees, I want to take care of them. How much ownership should I set aside for them? And again, no right or wrong answer, but you'll find some more defined benchmarks out there around this topic, especially if you're structured as a C Corp and you want to grant stock options, which is very, very common. I think most guidance will tell you that an option pool to set aside of 10 to 20% is probably well within reason. Again, no right answer. The mistakes that I see entrepreneurs make there is that they hand out options like candy. They just give it to every single person that's an employee. And why do they do that? Well, it's typically because and they should do this, they're viewing those options as currency. They're viewing it as a way to compensate rather than, in my opinion, have somebody exhibit a long-term growth, value-oriented behavior. And not everybody in the organization has the ability to effectuate that kind of long-term growth behavior. And so not everybody should be paid in the currency of options. So I look at that really as a, sort of as a, when you're giving out options, you should use a budget. It's almost a currency budget. If you're going to compensate somebody, you're using it instead of cash, right? So you're trying to preserve cash, you're trying to attract people, you're trying to retain people, you're trying to build that ownership mentality in a company. And that's great for key employees that are going to help you get there and drive that growth. But for some of the rank and file employees, they just don't have that ability, and therefore you shouldn't be handing that out. So that equity budget, if you will, that currency that you're going to use, is something that you should think about and model out over time in terms of how much equity you want to give to those people. And Craig, I'm sure will speak to this, that from an investor perspective, they're going to put the guardrails up in terms of how much of that equity that you're going to give away over a period of time, and where the dilution is going to come from. Because more likely than not, it's not coming from the outside investor's pocket, it's coming from the founder's pocket. And so you need to be very aware of that. And again, that's the reason why understanding your own cap table is critically important.
Jeff, I could not have said it better, right? You're probably going to give up a little bit more of your option pool early on, right? Because you have a 12-month existence. You're trying to not only attract employees to something that it doesn't have a long operating history, so you have to give them some sweetener. But you want to make sure you have the right alignment of incentives. You have the right people in the right seats on the right bus. And you might be a little bit more liberal earlier on in your company's history, but to Jeff's point, which is exactly right, you just don't want to, blanket give everybody options. You want to make sure that you have some strategic rationale. And then as you move forward in your operating history and you're raising later rounds, you're going to be giving out those options less and less. And they're going to be for employees that can really move the needle. A key sales and marketing executive, a vital operator, a vital product manager, the stuff that can really add significant value, fundraise to fundraise. There's where you want to give options, and not just options, but meaningful options. You want to give them enough, oomph behind their work to really kind of pour their heart and soul into it. And so just being able to judiciously allocate those options are real key. And I said it earlier on, one of the first things I look at is to see how much available option pool is available, to whom you've given options, in the past, how are key executives and key employees compensated. That's a real, meaningful part of my analysis. And any investor's analysis, because at the end of the day, 9 times out of 10, venture companies or venture-backed companies are losing money, right? You are betting on the people to really make something happen in a brand new market, and so you really want to make sure that you have the right people, like I said, on the right seats on the right bus, and you just don't want to give them out. Like candy, as Jeff said, but really have a method to the madness when you're kind of allocating, the options to make sure that, you have the right compensation.
Yeah, a lot of our discussion was around options, stock options, but I think this really applies to any equity instrument. If you're structured as a limited liability company, taxed as a partnership, that we're seeing many companies, almost all companies these days, granting profits interest in the partnership. And those profits interests are a really good way to try to align that behavior that Craig talked about with the potential liquidity event of the organization. There's some challenges around how to account for them and report for them, but when structured properly, most individuals are not really realizing any of the value that accretes to them until that liquidity event occurs. And so it creates that owner mindset. It aligns their behavior with the organizational behavior and the investor behavior. And just wanted to bring that up as a trend over the last, say, 5 years or so, that virtually every LLC taxed as a partnership is using that type of a equity incentive plan to motivate their key employees.
Jeff, since we're talking about option grants, do you want to speak a little bit about 409A valuations and why they're important? And I can certainly say that this is one piece where you do want to speak to your counsel before you're issuing options, because there are rules about how you issue them, and there can be adverse tax consequences if you don't follow those rules. So one of the things you've probably heard about are 409A valuations. So Jeff, can you talk a little bit about how they work, when the company should get them, and sort of what the rules are around that?
Sure, absolutely. Again, a very complicated topic in some respects, so we'll keep it fairly high level, just enough so you have a basic understanding of it. But 409A is an internal revenue code section. So it's a tax code section. It has nothing to do with financial reporting, accounting, auditing. And essentially what it says, it applies to non-qualified deferred compensation plans. And our last piece of our conversation was centered around stock options. Stock options are typically either incentive stock options or non-qualified stock options, which each have their own tax attributes. And stock options as a whole are those kind of equity instruments that are scoped out of Section 409A. 409A basically says that you have to comply with granting awards that are at fair market value in order to avoid the bad tax consequences that Chad was referring to. And in a nutshell, if a company awards something to you and it's not at least at fair market value, but it's under fair market value, which means that you are in the money, you've already conceptually benefited from that, the tax consequences are not on the company, they're on you as the individual. It's an individual income tax and a 20% excise tax on top of that. And so what happens in practice is that in order to prove that stock options, both ISOs and non-qualified options, are at fair market value, companies have this obligation to establish the basis for fair market value in accordance with Section 409A. And 409A does not prescribe that you have to go out and have a third-party valuation specialist. It does permit you, if you have somebody in the organization that has the skills and the knowledge necessary to provide a valuation of that equity instrument that would conform to the requirements of Section 409A, you can use that. But the reality is, it's a challenge, right? It's very difficult because companies will issue stock options. This is one of the common questions that we all get all the time is, I have an option pool. I want to hand out options in order to conform to 409A and make sure that the options are not in the money. What should the exercise price or the strike price be on those options? That exercise price or strike price has to be at fair market value. And so how do you come up with that? And I'm sure Chad has seen this. I see it all the time where a company they'll get started, they'll operate for a few years, they'll do maybe some seed stage fundraising. They don't really have a need for somebody like me yet at that point. Maybe I come in after an A round to do their first audit. And now all of a sudden, we have to measure that option award in accordance with accounting rules. And those are the stock-based compensation accounting rules, which are different than 409A. But the premise of value, of fair value, is can be equated. And from a practical perspective, we do equate it back to a 409A valuation. In other words, if a company has had a 409A valuation to help set the strike price of those options and to determine that they have complied with 409A, as an auditor, we will leverage that report or that calculation in order to measure stock-based compensation for the accounting rules. And so the question is always, what have you done to comply? Did you have an outside valuation specialist hired? Did you hire them to do a report for you to tell you what the value of your one share of common stock is worth? Or have you used Carta and has Carta determined that for you? And I think companies, in my experience over the last handful of years, have gotten much better at that because of having tools like Carta in place. But absent that, it puts the burden on management and the board in some ways to protect their employees, to make sure that they haven't put them in a position that that they're in the money. And it puts a burden on us if we don't have those reports as auditors to come up with what that value is. Very often, from a practical perspective, we will try to leverage a recent fundraising round. Let's say it's an A round of equity raise on preferred stock in this example, and we will use the preferred stock sale agreement and the terms that Craig talked about earlier, the liquidation preferences, the dividends, all those things that factor into what a preferred stockholder would get. We would look at participation rights. Can they participate or is it non-participation? And we might prepare a waterfall and try to derive a value of a share of common stock for purposes of valuing a stock option award. We then get into a whole nother topic around accounting for stock-based compensation, which is outside the scope of our discussion today, but that's the importance overall of a 409A. Why you need to have it in place to protect, management. Your investor, I'm sure Craig can speak to this. From an investor perspective, they want to make sure that that this insurance policy is in place of having a 409A, and then obviously all the financial reporting reasons that affect folks like me for having it in place. So I'm sure I missed something in that long-winded explanation, but Chad or Craig will correct any gaps that I had in that.
Yeah, Jeff, that was a great summary. And the last thing that we want, at least from an investor perspective, is there to be any hiccups, for the company or more importantly the employees, right? And so it's one of those foundational pieces that should always be in place. And so from the investor perspective, we can focus on material things as it relates to growing the business and building value, and not worrying about issues pertaining to the actual operations of the business, or things that company management and executives should be always mindful of, so that they never become an issue.
Great point.
Yeah, because I think it's important to point out that the adverse tax consequences can flow both to the recipient of an option that is not properly structured and the company itself. And I think that's why investors care about it, because they don't want the employees to be in a bad spot, and they don't want the company to be in a bad spot. The other thing I'd mention is we're talking about options, and that's the most common form of an equity grant, is because it's not taxable when it's granted, as long as it's structured the right way. It is only taxable when it is exercised, if it is exercised. Whereas if you're issuing someone an outright grant of equity that's fully vested to the extent the company has value, that would be taxable upon grant. And that's why options are often the most common form of equity compensation awarded to employees, because it does have that nice sort of deferral of tax until exercise. And often folks do not exercise until they actually leave the company, or until the company is sold. And that's, again, why you see that as a common form of equity compensation.
And I'm glad you brought that up, Chad, because that is one of the unintended consequences that unfortunately we see. Sometimes we'll start working with a company that haven't had the benefit of working with somebody knowledgeable like Chad, and they'll issue some restricted units where the holder is already vesting in those units, and it creates a taxable event to them. So now the poor individual is picking up phantom income. They're paying tax, real cash out of their pocket that they may not have. The company had intended to incentivize them, and now it actually becomes a negative. And we've had situations where we've counseled companies to actually rescind those plans, reverse those plans, and put something else that is more tax advantaged in place for everybody to not create those unintended consequences. So really important, to again work with somebody like Chad to be able to structure these to avoid those unintended consequences early on.
So I thought, we're at about 10 minutes left, 10 to 15 minutes left in our discussion. Maybe it makes sense if you all are in agreement to take a few questions that we've received. I can try to tick through those. One question I see here is, should a cap table include all investors, including the armchair investors mentioned in the previous session? Is there some threshold boundary? What I would say to that is no, there's not. I think anybody who has any ownership interest in the company should be reflected in the cap table. That would include convertible debt holders. I think it's also a nice, a good idea to include all of your convertible debt on a separate tab as that comes in, and then you can easily run a modeling exercise to determine how that debt will convert into equity when you raise an equity round. I've seen many companies not organize convertible debt financings properly, and they sort of have a bunch of notes sitting out there. It's much easier to keep track of that on a cap table. So I would say the answer is there's no threshold. Absolutely everybody should be included. It sounds like, Craig, you might have some thoughts on this as well.
Yeah, Chad, I completely agree with that. And I don't want to, kind of take away from some other questions that are being asked. But you raise a good point with convertible debt. And I'll even add warrants, both performance warrants and penny warrants, since I deal with that quite often. As an investor, and even from an entrepreneur standpoint, when they're looking at their fully diluted, ownership in the company and trying to model out their economic ownership in the company, oftentimes maybe between rounds, you're trying to get to that final milestone. You're looking right before your next raise, you want to add a little bit more value. It does make sense to raise a convertible note. There's nothing wrong with that, some sort of bridge financing. But with that, there's going to be some additional dilutive provisions to the kind of oncoming new investors and even some existing investors. And again, that's okay. So you want to make sure that you're mindful of those and you're adequately capturing those effects. But then also performance warrants or penny warrants, and they act similar to options. They grant additional ownership to the warrant holder. We oftentimes, as a strategic investor or a corporate VC, have warrants tied to our investments, because not only are we providing capital, we're a pilot agreement, an early customer adopter, a co-developer. And so we're trying to capture some additional value there. And so we might have warrants tied to our cash investment. And so one of the uses that we look at whenever we see a cap table, if I have a strategic, if I see a strategic on the cap table, one of my first questions, the first things I look for to see what other things might be attached, with that strategic's involvement that could potentially dilute me. And again, to Chad's point, which I fully agree with, capture everything on the cap table. It won't hurt you. It'll only hurt you if you don't capture, all the potential holders of stock at the end of the day upon a liquidity event, and you just don't have that visibility. You're not properly capturing that.
And I think there was a question here, I'm not seeing it right now, about a grant that was received pre-formation and whether that would be included. If it's purely a grant and the cash was not given with the expectation of ownership, that's different. But if the understanding and the agreement between the grantor and the company was that they would own part of the company, that should be documented, and that should be captured in your cap table sooner rather than later. But if it's just an outright grant, that would not relate to ownership, and therefore you wouldn't need to to include that. I see a couple questions here that sort of relate to each other, so I'll read them simultaneously. The first is, does a participation liquidation preference greater than 1 distort the valuation, particularly if multiple preferred classes come later? And I think similarly and relatedly, what is the impact of liquidation preferences on how future investors perceive the cap table investment stack? I can take a crack really quickly at the first one, and maybe Jeff can as well. I don't think that a liquidation preference would affect the valuation necessarily. I think the valuation it should be based on metrics that relate to the business. And as Jeff, I think, importantly noted, that is far more art than science. But that's going to relate much more to sort of where you are in the life cycle of the company. If you have a viable product, if you have revenue, recurring revenue. But I would say that I wouldn't conflate term sheet concepts like that with valuation, because I think they're separate and distinct concepts. Jeff, I don't know if you have anything to say about that.
Yeah, I agree, right? So on one hand, we have valuation and building value within the enterprise. On the other hand, we then are using those preferences to carve up that value into a waterfall upon some liquidity event. So it's important that all parties clearly understand what that potential waterfall looks like at different valuation inflection points. But I don't know that it necessarily drives the behavior for subsequent rounds of financing, especially in today's world where a lot of those preferences are pretty plain vanilla. I think people come to expect it, and I don't think that you're going to get a lot of behavior influenced by preferences, but you will based on trajectory of valuation.
I think this is actually a really good question, because not only, Chad, Jeff, you're right, it might not impact valuation, but an entrepreneur should be very mindful of the term stack as they raise additional rounds, because oftentimes these terms will stack upon one another. So a Series D investor might have preference over a C, who will have preference over maybe the A and B investors who've been lumped together now as one share class before the common shares eat. And so it is something to be mindful of, again, as you raise additional funding rounds, that it's only going to distort your economic outcomes versus your share ownership outcomes that you see on the cap table. So it is something to be mindful of. Again, don't be scared. It's going to happen, but if you are growing the pie, it'll still take care of itself if you're building a great company at the end of the day. But that is something to be mindful of, and it is a really great question, because oftentimes they will stack upon each preferred share class.
Yeah, and I would say, as it relates to the second question, every term you give an investor is going to set a precedent for the subsequent round of financing. So it can go either way. The later investor may say, well, if if I'm the C investor and the B investor had this particular term, I want that too. Yeah. Or they're going to say, that's not a meaningful term to us, but we're going to require that the B give that up in order for us to invest. Yeah. But at the end of the day, there will be symmetry, when that later investor comes in with what the prior investors received.
Yeah, right.
I think we have a few more minutes here, so I can try to hit a couple more questions. One, I think, seems like it's tailor-made for Craig, which is, as an investor, is there an item or two we should be looking out for as a red flag related to a cap table and a term sheet? I'll even though I'm typically more on the company side, I'll say to that, as the investor, you're probably to some degree not dictating, but you probably generate the term sheet, at least initially. And so, you probably have the set of terms that you care about. I think about red flags more from the company side, but Craig, I'll let you respond to that if you have any thoughts.
Yeah, right. And just assuming that I'm interpreting the question right, a lot of what we layer into the term sheet is based upon the information and discussions with management, right? And so if there's more red flags that we uncover, we're going to layer in tighter terms and conditions to our funding in the term sheets, right? If we have great discussions, everything's clean, there's a great foundation built. A lot of the extracurricular terms and making them, tighter and more investor friendly are not going to be there. Where they become more and more investor friendly is whenever we're going through kind of a pre-term sheet diligence review. We're having discussions with management. Things are not really buttoned up how they should be. We're worrying about things that, we're talking about items that we shouldn't be, rather than relating to growing the business. That is when we're going to have more, kind of more investor friendly terms, because we're only seeing more and more risk in our investments. We just want to make sure that we are being protected.
I think maybe we have time for one more question. Let's see if we can pick one here that I think is a good one. There's a question here about 83B elections. So since that's a little bit more perhaps in Jeff's domain, I mean, I could certainly speak to that as well, but I'll let Jeff maybe give a 60-second primer. That'll be his challenge on 83B elections.
Yeah, it's fairly high level. An 83B election is conceptually just a way for an investor to lock in some tax on some gain. So they'll actually make this election. They'll pay the tax on a lower value of their equity award early on. And what that does is it helps lock in a capital gain for them down the road when they go through a liquidity event. So, it's almost an automatic thing that you do just to make sure that that you can lock that in. The downside is that you come out of pocket, you pay the tax, and for some unforeseen reason, the company loses value, and now you're out of pocket tax that you're not going to get back. So there's a risk to it, but I will tell you the rewards far outweigh the risks. I think it's rare that we don't see an 83B election. We advocate for it. I'm sure Chad advocates for it all the time. It's just one of those necessary things that you need to do. There's a lot more to it, but at a high level, that's it.
Yep. The other thing I'll add is that that election has to be made within 30 days of the date of the grant. There's no exception to that, and obviously, you can't miss that deadline.
Yep. Good point.
So we're, I think, at the point where I'm supposed to turn this back over to Jeremy, so I will do that. I just wanted to say thanks to the PBCA for having us today. Jeff and Craig, it was a pleasure speaking with you about these topics. Let's do it again sometime. There's a lot more to cover, but hopefully we gave the folks listening something that they can sort of digest and is meaningful to them. So thank you very much for having us.
Welcome.
Terrific. Chad and Jeff and Craig, thank you very much for that. I don't know, we'll talk to the folks at the PBCA. I know there's a bunch of unanswered questions, and if it's possible, maybe we can figure out how to filter back some of those. One thing, just because I am on the company side of a company, Carta does have a new modeling feature. So Chad, you can get your spreadsheets. And it'll also let you model, and one of the questions was on safes. It's interesting, they'll let you model a safe. There's, I will say the other thing, and not to make this an advertisement again for Carta or other sort of portals, there's a Board Book, it's another good one. It doesn't do cap table management, but does a lot of good stuff for boards. Those things help you get organized and also control versions. And I will say, Carta throws in a 409A, I think, one a year for free. So that keeps you disciplined as well. Thanks to the folks at the PBCA who put this together, Micah, Jordan, Ian, the whole team there. It's been a lot of hard work in doing this virtually is there's a few bumps in the road, but having folks in different locations and trying to pull this together is not easy. So I want to thank those folks. And then there will be a survey link that comes out at the end. If you could provide your feedback, that would be terrific. Again, I can't promise that we can get to those questions, but I'll circle back with Ian and the team, and if there's a way that we can maybe hook our panelists up with folks to try to get those unanswered questions answered. Our next session on the educational series, the symposium, will be held tomorrow at 11:15 a.m. It's 11:15 to 12:30, and we'll discuss customer acquisition in sales and marketing and branding aspects. Please visit the pvca.org for more information. And once again, thank you for attending the session. The stuff that was talked about today, really, there's a lot there. I think folks, the takeaways of some of the things to do and certainly not to do, some great advice from all three of you. So thanks again for putting the time in. And you guys look like pros, so maybe you should take this on the road. We'll franchise it. Thanks everyone, and look forward to seeing you tomorrow at 11:15 a.m.